Hi, it's Mike Carpenter again, frequently and sometimes affectionately known as Mike the Money Man. I'm a mortgage broker in the state of Washington, and my license number is 111356. In this segment, I wanted to talk about VA loans, and I wanted to talk about who qualifies for VA loans, what a VA funding fee is, and how to calculate a VA funding fee, and who's exempt from a VA funding fee. So, in many of the videos so far, I've alluded to VA loans. I've talked about VA loan limits, and I've talked about the VA jumbo, and I've talked about something called the VA funding fee in the section on mortgage insurance. And if you haven't viewed that, you should, so you can get a little bit caught up on mortgage insurance. But a VA loan is got two unique features. It is a zero down loan if the veteran wants to do zero down. And one of the unique features, there's something called the VA funding fee, which is very similar to FHA's upfront mortgage insurance premium. And if you're curious about FHA loans, check out the section on on FHA loans. So a VA loan is open to veterans who are in the Army, Marine Corps, Navy, Air Force, Coast Guard, Reservists, and the National Guard. And they're dictated by the county loan limit on which the veteran is buying the property. So in King, Pierce, and Snohomish counties, for 2019, the loan limits are $484, $350 for conforming, and $726 for a high balance conforming. And then there's something called the VA jumbo, which I'll get to in a second. But they have to be in active duty or honorably discharged. And they're also open to the spouse of veterans who've passed, as long as the spouse has not remarried. So I have put together several matrices that talk about the VA funding fee. So typically, the VA funding fee is added to the loan. So if somebody's buying a $400,000 house and they're putting zero down, the VA funding fee would be 2.15% of the loan amount. So all you do is take the loan amount times 1.25, which is $8,600, which is 2.15% of the loan amount, and your final loan amount is $408,600. One of the features of a VA loan is that there's no monthly mortgage insurance payment that is added to the monthly payment. It is all financed through something called the VA funding fee. And typically this is added to the loan amount. It can be paid, but it has to be paid in full. Some people say, well, can I pay part of my VA funding fee when I fund the loan, or when I close the loan, can I pay $3,000 of the VA funding fee in advance? The answer is no. It all has to be paid in advance or financed in the loan amount. So let's get back to our matrices here. So if you're regular military and you're buying and you're putting no money down, and your VA funding fee is 2.15% of the loan amount added to the loan. But it changes on the subsequent use. Let's say that you bought a house, you financed it, you bought a house for $400,000 and you financed the VA funding fee and you put nothing down, and you sold that house. The next use is 3.3%. So first use, 2.15, subsequent use is 3.3. And then it's 3.3 every time you use it again. Some people might consider that unfair, but I don't make up the rules. And the VA funding fee depends upon whether or not you are in the Reservists or National Guard, or whether you're actually putting some money down. If you're putting 5% down, it's 1.5% of the loan amount added to the loan. And the subsequent use is always 1.5. If you're putting 10% down or more, it is 1.25, and it's 1.25 for every subsequent use. But the National Guard, Reservists or National Guard are slightly different, and I don't know why they make a distinction, but they do. If you're putting 0 down, the first time use is 2.14% of the loan amount added to the loan, and 3.3 for every subsequent use. So for every time you sell and rebuy and sell and rebuy and sell and rebuy, it is always 3.3%. And if you put 5% down or 10%, it's 1.75 for first use, and 1.5 for first use, or 1.75 and 1.5 for every subsequent use. Those are the rules, and every once in a while they change these up. These are usually pretty standard, and they haven't changed much over the years, but like FHA funding fee, FHA upfront mortgage insurance premium, sometimes they reevaluate it and they change it. And it's somewhat different if you're doing a cash-out refinance versus a purchase. If you're regular military, if you're doing a cash-out refinance, it's 2.15% of the loan amount added to the loan, and 3.3 for every subsequent use. And it's slightly different for Reservists and National Guard. But if you're doing the VA equivalent of a rate and term refinance, or what they call the interest rate reduction loan, you're not getting rid of your mortgage, your existing upfront funding fee. They just add 0.50 to your existing funding fee for an interest rate reduction loan, and strangely enough, 1% for manufactured homes. And those are the VA rules. But I alluded to, and I've spoken in the past about something called a VA jumbo. So we had drawn a diagram previously, and I'll do it again here, and I'll try to do it in a way that you can actually see me. We've talked about the conforming loan limit and the high balance conforming and the jumbo loan limit. And we drew this diagram, and we stated that in King, Pearson, Snohomish, it is 484, 350, and 726, 525. And we stated that anything greater than 726, 525 is jumbo. So you might be led to believe that a veteran who wants to do a VA loan cannot go above 726, 525, and that is untrue. There's an exception to that rule. So most standard VA loans go up to 726, 525. But you can go above that as long as the veteran is willing to put, the rule of thumb is 25%. That is, there's actually something of a complex calculation which goes into figuring out how much they have to put down if they want to buy something bigger than 726, 500. And this is not the exact calculation, but it's kind of a rule of thumb to go by. So let's say our veteran wants to buy a house for $800,000. They can do that as long as they're willing to put 25% of the difference between this and this. So let me grab my handy calculator. 726, 525, and 800,000. So the difference between 726, 525, and 800,000 is $74,000 $18,750. And as long as the veteran is willing to put down 25% of this amount, or $18,618.75, then the VA will finance the extra money to span the gap between these two. So as long as the veteran is willing to put down $18,618 on an $800,000 purchase, the VA will finance the difference between the two. So, in theory, this can go up to whatever number the veteran wants to do, as long as he or she is willing to come up with 25% of the difference between this number and whatever they're buying. And that is a broad overview of VA loans. Hey, it's Mike again. I wanted to append this video with some additional information regarding VA loans. Firstly, I wanted to talk about disability. If the veteran has a service-related disability, there is no VA funding fee. The DD 214, or the Certificate of Eligibility, will tell you whether you are exempt from the VA funding fee. But if you are, none of the previous matrices regarding first use and subsequent use apply to you. You're exempt from the VA funding fee, and there you have it. I also wanted to talk about, I guess rates or eligibility. So we had mentioned that there's conventional loans, FHA, and VA. So as a general rule, VAs and FHAs are more forgiving in terms of derogatory events and credit score. Usually you'll get a little bit better interest rate on a VA loan and an FHA loan than you will a conventional loan. And VA loans will go down to lower credit scores without having much in the way of hits in terms of rates. And I believe VA loans are 2 years on sort of major derogatories, and so are FHA loans. For example, a major derogatory is going to be something like a foreclosure or a bankruptcy or a short sale or something like that. So they have shorter seasoning periods on short sales and bankruptcies than do conventional conforming loans. And I also wanted to talk about interest rate. I wanted to further clarify a broad information regarding interest rate reduction loans. So interest rate reduction loans, we had mentioned, were the VA equivalent of rate and term refinances. So interest rate reduction loans, there is no income qualifying and no appraisal needed. If you've made your payments on time, then you are allowed to reduce your interest rate without having to get tax returns, pay stubs, W-2s, things of that nature. The only thing that you need is your DD 214 or your Certificate of Eligibility, and there needs to be a credit report, which I get. And there needs to be a title report, which I get as well. And there are certain tolerances for getting a lower interest rate on an interest rate reduction loan. There is something called the net tangible benefit. There has to be a benefit. You can't just refinance just to refinance. And if you're going from a fixed, this varies from lender to lender. But if you're going from a fixed to a fixed, there has to be a certain threshold in reduction of interest rate. And I believe that it's a 0.25%. So you can literally go from 4.25% to 4% without any income qualifying or any of the things that you normally have to go through. But if you're going from an ARM or adjustable rate mortgage, if you want to know what an ARM is, check out the section on ARMs. For an ARM to a fixed, I don't believe that there's a tolerance. There's no rate tolerance. In other words, you can go from, say, 4% on an ARM to, say, 6% for a fixed, because going from an ARM to a fixed is considered a net tangible benefit. So I just wanted to clarify a couple of those bits of information. So thanks for watching my video. I hope you found it useful and informative. It's intended as a broad overview of the material so that you may have some further questions. Feel free to ask them, and I'll be happy to answer them as best I can. Share, like, and subscribe, but share it with somebody who can actually use it. Maybe someone who's going through the loan process and is a little confused. Hope they get something out of it as well. So happy viewing. There's more to the series. Hope you enjoy the rest of the videos. Thank you. Bye-bye. And now for a quick disclaimer. So these videos are intended for informational purposes only. So don't rely on them for making important financial decisions, especially decisions concerning your housing. If you've got any questions about how this information applies to your given situation or your given transaction, please contact your mortgage broker directly, and they can give you advice. And any rate, fee, cost, or loan limit information was accurate at the time that the video was made, but may not be currently accurate because underwriting guidelines change all the time. So if you've got any questions about how this information relates to you specifically, contact your mortgage broker. So I hope you continue to enjoy the series. Thanks.